Hi everyone, let's explore this capital budgeting scenario. And this is going to be a personal scenario rather than a business scenario. Okay, here's the background. You're considering buying a washing machine. It'll cost $800. You think it will last 10 years. At the end of the 10 years, you don't think it's going to be worth anything. And we're going to assume it won't need any repairs over the 10 years. Okay, some other assumptions is that the laundromat and dry cleaning savings you expect to get after buying the washing machine will save you $75 a month, but it will result in added water, electricity, and detergent costs, and we're using an $11 estimate of that. All right, so I'm going to calculate net present value first, and first let's do it on an annual basis. We're going to assume the appropriate discount rate that we would expect to earn on the funds that we would invest in the washing machine and the next best alternative to be 8%. Whether that's realistic or not is not the point. It could be lower, it could be higher, but we're going to go with 8%. Okay, and we're going to calculate net present value. So here's what I've done. I've listed the period and the cash flow, and I'm going to do this on an annual basis. So period 0 means right now it's going to cost us $800, so that's an outflow. Well, what about period 1? The end of the year, we're going to say, take the $75 savings less the 11 added costs for an incremental cash flow of $64 a month, multiply it times 12, we're going to get $768 savings. And we're going to get that savings every year for 10 years. We're not using any assumptions about what the cost of water, electricity, and detergent, how that will rise. We're just going to assume it's constant for simplistic purposes. So let's calculate net present value, and Excel makes that easy for us. It has an NPV formula. So we'd say equal NPV, hit the left paren. I like to call this up. So we get a list of the function arguments, and then you start putting in what you need. Well, the rate is 8%. And then it wants to know the values. Well, the values appear in the schedule. Let me move this out of the way. And you have to start at period 1, not period 0. Now, why? That's the way it's built. It tells you an NPV function returns present value of an investment based on a discount rate, a series of payments, and income starting at the end of the first period. Okay? It's the end of the first period, not the beginning one. So if I hit enter right now, that's the net present value of just the positive cash flows. All right, so what else do I have to do to that formula? Well, I've got to subtract out or add in the negative $800. So you see that this is a very favorable net present value, which I think makes sense because it cost you $800,000. It's going to save you $768 at the end of 1 year. In fact, if you wanted to do payback on this, right? You could calculate payback very easily by just taking the $800 cost. I'm going to make that a positive number. $800 divided by the annual cash flow, $768, and it's going to pay itself back in 1.04 years. Okay, and we can use that approach because the cash flow is constant in all years. Now, we couldn't use that approach if the cash flow changed. And I have other videos that illustrate payback, so you can take a look at those if you want. Now, if we wanted to be a bit more accurate, we could produce this on a monthly basis as well. Okay, so let's say we want to do this on a monthly basis. Well, we've got to make a couple changes. First, the rate is no longer 8%. The rate we would have to use is 8% divided by 12, which comes out to be 0.666667. We're just illustrating or showing 0.67 here, but it does go on and on and on, right? Lots of decimals. I'm not rounding it here. And then you've got to break the cash flow down for period. Now, this time we're on a monthly basis, right? So the month would just be the 75 less the $11. Okay, so we take the 75 less the $11. And that would be $64. And then we just are going to copy that all the way down. Now, it goes down 120 periods. Let me slide down. I'll show you that. Oh, I just moved these out of the screen. Let me get rid of them now. And you'll see we go down 120 periods. Okay? So this time I'm going to do the analysis up top. Well, I'm going to put it at the top. Sometimes I put rate and NPV below. That's usually the way I do it. But since this goes down so far, I thought I'd just put it at the top. Keep in mind, Excel doesn't care where you put the formula, as long as you give it the proper numbers. So now if I do NPV, I could say equal NPV, hit left parenthesis. Hit that, insert function, this pops up, says what's the rate? Well, now the rate is right here. And it wants to know the values. And again, we start at period 1, and we're going to slide all the way to the bottom. Now, we can do this because it only goes 10 years. There is a limitation. Like if you look at the values in here, when the function comes up, it says you can only do 254 periods. Well, we're going 120, so we're okay. All right, let me hit OK. Puts us back up. Now, again, that's the net present value of just the future cash flows. And from that, we would have to subtract out the initial cash flow. Now, you may wonder, why is this number different from this one? Well, it has to do with compounding. This assumption assumes we're going to get savings on a monthly basis, and that monthly savings can be put into monthly investments. This assumption over here on an annual basis assumes we're only going to get the cash back at the end of each year. Okay, so which one is the more accurate approach? Well, certainly this one would be. If we're going to use the use the washing machine to save on laundry and dry cleaning bills on a monthly basis, well, we're going to get the savings on a monthly basis, and we should be able to use that savings and put it to good use instead of just putting those savings under a mattress and then investing it at the end of the year. Okay, so again, this gives you an example of how to do this. Now, if you wanted to do payback, we should get the same answer, but it's going to look different because it's going to come back in months, right? So we would say equal 800, I'm going to make that a minus, divided by 64, and it comes back 12.5. Well, if we divide 12.5 by, that's in months, right? This is payback in months. If we wanted payback in years, we would divide the 12.5 by 12, and we get the 1.04. Of course, this is payback in years. Okay, so that's just a quick example to illustrate net present value using a personal scenario rather than a business scenario.